Well, good afternoon, everyone. Welcome to today's financial check-in with FAME. We're so glad that you are here. I'm Mila Tappan, and I am FAME's manager of education affordability, content, and training manager. Said that a little backwards. Today, we are going to be talking about tax benefits for education and for student loan repayment. This session is being recorded and will automatically be sent to all of the registrants early next week. I am so excited to introduce today's presenter. With us is Allison Bishop. Allison has been a CPA for 28 years and in 2015, started her own business as a financial coach. We are really fortunate at FAME as a FAME employee that we get the benefit of having Allison as our personal financial coach. So you are in super great hands today. Allison will be moving through the presentation, but stopping periodically to address questions. So please go ahead and put your questions. I prefer it in the Q&A, but if you put them in the chat, we'll pick those up as well. So with that, I'd like to go ahead and get started. Allison, I'm going to turn it over to you.
Hey, thank you. Yeah, as Mila said, my name's Allison Bishop, and we're here to talk about tax benefits. Okay, so I broke this up into there's three stages, right, when you're talking about college and taxes. And the first one is usually for babies and children, school-age children, which is the saving for college phase. And then we're going to talk about during those years that you are a student or you're the parent of a student. So that'll be talking about tax credits available for students in college, things like if you want to receive gifts or you want to give gifts, and then how scholarship income is taxed. And then afterwards, the only thing lingering is for those folks who have student loans. So what are the tax deductions and credits for repayment of student loans? Okay, so we start with before. All right, so this is just the universe of all the things I'm going to talk about. I have a slide for each one of these, but just so that you have a sense going into it. And all of these types of accounts all have some provision for education. So there's a couple of retirement accounts on here, but there are tax-related things about education for them. So we can start with the first one on the next slide. Okay, so 529 plans. And I put this first. So this is actually going to be the thing I talk about for the longest of all the slides, because when we talk about saving for college, we most often talk about 529 plans because that's what 529 plans were designed to do. I actually did find two sentences about the history of 529 plans. First of all, what are they? It's a tax advantage investment account. It's named after the section of the tax code. In Maine, it's called NextGen, and it's administered by the folks at FAME. So it was 529s were created in 1986, and then in 2001, they added the provision that distributions for education could be tax-free. And so at that point, they exploded in popularity. And now I think most parents are aware of the existence of 529s, even if they don't personally use one. So the way they work when used for education is we put after-tax money in there, meaning we don't get a tax deduction on our federal taxes. You put after-tax money in there, and then while your child is a student, it grows tax-free. And then at the time you use it for qualified education purposes, you take it out. There are no taxes on the earnings, and there's no penalty or anything. It just comes out tax-free. If I were to use it for something other than qualified education expenses, when it comes out, because I can withdraw my balance at any time, the money I put in is after-tax money that comes out, no taxes or penalties. But any sort of earnings that went in the account, if I'm withdrawing those for any purposes other than education, it's taxable income to me in that year, and there's a 10% penalty for not using it for education. So that's kind of like the general framework of how they work. So in all these different slides, I'm going to use the term qualified expenses, and it's going to mean something different for almost everything. For 529s, the definition of qualified expenses is extremely broad. I would say probably the broadest definition. So it is things like tuition, fees, housing, food, books, supplies, anything that is required for you to attend, let's say lab fees for a class, or if you need to buy steel-toed boots in order to take the class, that is all qualified expenses. It does not include travel that to me is kind of the biggest thing that is excluded. Um, okay, so although I said after-tax income, you can, many people can get a tax deduction on our state income taxes. So federal income taxes, there's no deduction for contributing to a 529. But for Maine, um, you can deduct up to $1,000 of contributions per year per beneficiary. So if you are contributing to 3 529 plans for 3 different students, you can have a deduction of up to $3,000 in your tax return. This deduction we used to have, they eliminated it for a few years and it came back in 2023. I tend to talk about things that sort of how the tax law has changed, because sometimes people are like, hey, I thought that deduction went away. It did go away, but it came back in 2023. There is, as many things are today, there are income limits. So you can take this tax deduction if your income is up to $100,000 if you are filing single or married filing separately, and $200,000 for head of household or for married filing jointly. There is, and I think Mila's going to put it in the chat, a 529 plan state tax deduction calculator. I used it the other day. And you can put, it's not just for Maine. So if you are a resident of a different state, you can put in what state you live in. I think I had to put in my income, my filing status, and how much I was contributing. And then it will estimate for you what is the tax benefit off your state income taxes. One thing I forgot to say, I apologize, and I want to say at the beginning, is there's disclaimers on the bottom of this, of all the slides, which I just wanted to reiterate, which is that this is informational, educational, and is not tax advice. This is just, what are the tax rules for all the different types of things that we're talking about today. Okay, so how much can you contribute? I kind of want to say there's no limit. The limit over a lifetime is like $500,000. So it's far above what most people would do. A lot of people will say, oh, you can give $19,000. And that is the gift tax exclusion for 2025 and 2026. So many people have old numbers in their head, right? Like 14,000, 15,000. For 25 and 26, it's $19,000. But there's a lot of misconceptions about gift tax, that kind of exclusion limit, which is that if you were to give above that, let's say I gave somebody, and you can give anybody in your life this is not limited to family members. I can give anybody in my life up to $19,000 without tax and without filing a tax return. If I want to give above that, I can still give it, and there's actually no gift tax. I just have to file an informational return. And the informational return just accumulates information about your lifetime giving. At this point, what the tax law says is you can give away up to $15 million per person without triggering gift tax. So it's not suddenly, if you give over $19,000, it does not mean that you're paying gift tax. The other thing about gifts is that if you are married, you can do what the IRS calls splitting gifts. So let's say I'm married, I want to give someone $25,000. Even though it's above my exclusion of $19,000, I can elect to say, oh, my spouse is giving half of this gift. And so we can each give up to $19,000. So I'm going to talk about splitting gifts later. That's why I bring it up here. So the other thing that this is specific to 529s is that you can superfund a 529. And what that means is you can contribute up to 5 years worth of that gift tax exclusion in 1 year. So in this case, for right now, that would be $95,000 per gift. You still have to file a gift tax return, but it's sort of totally fine to do. But then what you can't do is give that same beneficiary any more gifts for that 5-year period. You're just sort of front loading 5 years worth of gifts. And as far as I know, it only applies to a 529. Okay, so then there's some grants available for Maine residents. So you might have heard of the Alphon grant, and that is $500 set aside for every baby born in Maine. And then once the parent, guardian, whoever opens a 529 for that child, $500 is put into that account. Also, there are matching grants for Maine residents. And there's websites on the slides that you can learn more about what those are. So a little bit more about 529s. Up to $10,000 of it lifetime can be used to pay off student loans. And then as far as K to 12 education, this is just changing this year. So until last year, the federal government in 2018 had changed it. Before it had only been college, university, higher ed. Then in 2018, the federal government said you can use up to $10,000 a year to pay for K through 12 education. And again, a different definition of qualified expenses. Um, in in this year, 2026, HR1, which is the big beautiful bill, that amount doubles to $20,000 a year, and the qualified expenses expanded. Like the one thing I happened to notice was I think it was including SAT test registration, which wasn't included before. The other thing I'll say about that is that some states said, okay, sure, for the federal government, this is not taxable income. When you take out, again, this would be your contributions come out tax free. The federal government says, okay, up to $10,000 a year or 20,000 now, the earnings will also be tax free and penalty free. So some states said have conformed to that. Maine is one of them. So Maine is the same rules as the federal. So if I take out up to $20,000, the earnings on that is not taxable for me. Some states, I'm just saying this because there may be people in other states, some states are not conforming and said, okay, for federal government purposes, yeah, it's tax free. For our state government purposes, that is not tax free because that is not used for higher ed. So you just have to know what your state is, what the rules of your state is, if you are going to take out money for K to 12 education. I get some pushback for when I'm talking to parents about setting up 529s. The pushback I hear is that they think it's too restrictive, right? They say, I get a lot of what ifs. What if my child doesn't go to college? What if my child gets scholarships? Those are the two biggest ones. But 529s are super flexible. So number one, you can you can change the beneficiary's name on the account once a year. So if you have another child, grandchild, niece, nephew, you can change it to yourself. If you think, hey, I might want to go back to school or I might want to pursue education, you can change it to yourself. If your child, let's say you have one child, you put all this money away and they get some sort of big scholarship, you can withdraw the amount up to the amount of the scholarship without the penalty. It becomes tax deferred income. So you'll pay taxes on it, but there's no penalty. It's kind of turning into sort of like an IRA, that sort of taxation where you don't pay taxes during the time it's growing. And of course, always, as always, your contributions went in tax after tax. So those come out tax free. We're only talking about taxes and penalties on earnings. And then the other thing that started in 2024, which is, I think, helped a lot of people get over their concern about 529s, is the ability to roll up to $35,000 into a Roth IRA for the beneficiary in the beneficiary's name. So there's a couple of rules. The account has to have been open for 15 years because I think I'm guessing they don't want to make it to just sort of a wealth transfer for wealthy families. It's intended to use for college. You've had it open for 15 years. And then I'll say the student, the beneficiary has to have, it's sort of like the regular rules for contributing to a Roth. They have to have earned income up to the amount that you're going to transfer. And the limit to transfer per year is the regular Roth contribution limit. So around $7,500. And then, like I said, the lifetime rollover is up to 35,000. I think that's it on that. And then in terms of financial aid, because I as a parent of teenagers, I'm thinking about tax benefits, I'm thinking about grants, and I'm thinking about financial aid all together when I'm making decisions about how to save for my kids' college. So I'm going to talk about financial aid for all of these. So 529s are pretty beneficially reported on FAFSA, which means that they are reported as a parent-owned asset. So up to only 5.64% of the balance in the account is considered available to pay for college for the year that you're applying. Also, this changed a couple of years ago, but now you only have to report the FAFSA balance, the 529 balance of the student whose FAFSA you're filling out right then. Right. So next year, well, even this year, I had 2 FAFSAs to fill out. I only reported that student balance. If you are doing the CSS profile, which is maybe like 300 schools, it's a more in-depth look, you report all of them. Then any money that comes out, let's say my son's freshman year, I am pulling money out of the 529. that doesn't then count as income. Then in a couple of years, like let's say, for 2025, he was a freshman and I pulled out, I don't know, $15,000 to pay for the first semester. I don't then report that as income in 2 years when I'm filling out the financial aid form. Whereas some of these things that we're going to talk about, you do have to report it as income. And then lastly, if you have a third party 529, meaning usually that would be a grandparent owned 529, sometimes aunts and uncles. Um, that asset is not reported on the FAFSA because the parent and the student don't own it. And truly, the person who owns it could, as I said before, they can take the money out at any time. It's not controlled or owned by the parent or student, but distributions used to pay education expenses would be counted in the tax year. So if that, let's say it was fall of 25 and your student gets a gift from the grandparent from the 529 plan, then what I say, fall of 25, then in the fall of 27, I'm filling out FAFSA again using the 2025 tax year. I would have to report that distribution as a gift. So it's untaxed income for the student.
Allison,
For
actually,
the
if you
student.
don't mind if I jump in,
Please jump in.
with FAFSA simplification, students no longer have to report untaxed income.
Oh, I'm so
Yes.
sorry.
Yes, no, it's a pretty recent change.
Thank you for
So
correcting me.
yeah, so that doesn't have to be reported
Oh,
at all.
you know what? I'm thinking of the CSS profile.
Yes,
On the
exactly.
CSS
Yeah,
profile, you do. I
yes,
fill out both. So
exactly.
thank you for correcting that. I'm so sorry that I got that
Oh,
wrong.
no, no, there's been so many changes in the last couple of years. So
So
thank you.
many changes. Okay. So Mila, are there questions about 529s? Because that was a lot of information I just gave.
Yeah, no questions at the moment. So I feel like as we move on, if a question arises about a 529, it's not too late to put in that question. But none at the moment, Allison.
Okay. Perfect. Then we can move on to Coverdell. I feel like I hear a lot about Coverdells. I don't actually encounter these out in the wild. I don't know a lot of people that have Coverdells, and maybe they used to be more popular before 529s kind of exploded in popularity, but that is just my speculation. So basically, what this is, it's sort of like a 529, but for K to 12. You can use it for higher ed as well. So it's a custodial education account for all education, kind of all years of education. Like I said, K to 12 and also higher ed. It's a lot. Um, so the contribution limit is much smaller. And I didn't realize this at first, but the $2,000 per year is not just, let's say, what I can put in my child's 520 Coverdell. It's actually what everyone can put in a Coverdell for one student. So everything I was reading was sort of talking about you need to coordinate among grandparents, aunts and uncles, and parents because the total amount of contributions for any one student can't exceed $2,000 in a year. Um, so the income limit, there's income limits on almost all of these things. The income limit is sort of similar. Sorry, there was no 529 income limit. That's one benefit is that any income can contribute to a 529. So for this one, if your income is, you can contribute if your income is under 110,000 for single filers or 220 for married filing jointly. But there's a bunch of limitations on this. So you cannot contribute once the beneficiary turns 18. And then by the time they turn 30, either the account has to be emptied or the balance has to be rolled into either a 529 for that person or someone else, or a Coverdell for a younger, for somebody younger. I think it has to be a younger family member. So for Coverdell, you don't get that $1,000 per beneficiary main income tax deduction, and there are no grants available. In terms of college financial aid forms, it's basically treated the same way as a 529. So parent owned, the same rules about, yeah, all the same rules. I feel like I'm seeing activity. I can't see the chat, but I'm seeing like a little bit popping up.
Just had one come in. Can parents contribute to a next gen 529 after the child is more than 18 years old?
Yes, absolutely. I have a 20, how old is he? 20. I continue to contribute. I'm mostly for the tax deduction and for the matching grant.
Mhm.
So yeah, I am and debating in myself internally, when do I stop?
Well,
But
and
that's why I do it. It's for the tax deduction and the grant.
Yeah. Well, and I continue to do it all the way through my kids as well. And I do think it's something that we want people to know. Like if you're, let's say you are someone and in your job, you need to take classes in order to maintain
Hmm.
certifications and things, you can open up a 529 account for yourself. And you can get the matching grants if you're eligible as a Maine resident. And you don't even have to be enrolled in a degree program. You have to be at a degree, an institution that's eligible, but you don't have to be in a degree program, and you can still use your 529 funds to pay for those courses. So, as you mentioned at the beginning, there's so much flexibility. So,
Yeah, exactly. Okay, I think we can move on to UTMAs and UGMAs. So this stands for Uniform Transfers to Minors Act and Uniform Gifts to Minors. So the reason that I see parents who prefer this is because it actually has nothing to do with education. It's just not restricted in any way. So a lot of times they'll say to me, "Oh, I want my if they want to go to college, they can use it for that. If they want to start a business, I want to let them use it, buy a house." Like those are the kind of the big things that I see. Um, but so the tax benefits for this kind of account is it has nothing to do with paying for like qualified education expenses. What it is the investment income on this account because it's all invested. It's like stocks and bonds. And so the first $2,700 um, are taxed at a more favorable rate. Any investment income over $2,700 is taxed at the parent's tax rate. And a lot of times, families that are funding things like UTMAs and UGMAs are more typically in a higher tax bracket. Um, so that's the tax. Um, you can use it, of course, for college. Um, there's again no tax deduction for contributing. There's no matching grants. The big thing that's a difference here is that the other accounts I talked about are almost always owned or controlled by the adults in a student's life. This one is controlled by an adult until the age of majority. And so what I could find out is the age of majority in Maine is 18. I think if you're opening an UTMA or an UGMA, you may be able to elect it to be 21. But either way, as soon as the student hits that age of majority, all that money is theirs. As much as I trust my children, I I like to be. I don't know how much money I really want to give a 21-year-old, or certainly an 18-year-old. And then in terms of financial aid forms, is if you are a family that's hoping for some need-based financial aid, this may not be your best option compared to a 529 because these are considered student assets. And so up to 20% of the balance is considered available to pay for college versus I said at the beginning 5.64 if it's a parent set. So just consider, I mean, of course, and you can do both, right? And most of these things that I'm talking about are not mutually exclusive. You can do both. You could put money in a 529 and you can put money in an if you want to. But I think that's all I had on that. Okay. So Roth IRAs, which again, I said at the beginning, we're going to talk about a couple of retirement accounts because there are provisions related to education for these. So when I, in the first bullet, I said similar income tax treatment as 529s. And I don't, what I mean by that is just the way it grows. So if you have a Roth IRA or a Roth 403b, what you'll know is you put in money after tax. You do not get a tax deduction for that. And then as it grows, probably during your working life, tax free. And then in retirement, so long as you've had the account open for 5 years, this is specifically for IRAs, not 401ks, had the account open for 5 years and you were at least 59 and a half, that all the money comes out tax free. And so this is kind of similar as well in terms of all my contributions. Let's say I contribute money to a Roth, I can pull out those contributions at any time. I don't have to be 59 and a half. There's no tax, there's no penalty. It's the earnings on the Roth. Um, and so similar, if I pull it out before I'm 59 and a half, I will have that earnings will be taxable and I will have a 10% penalty on the earnings. So that's just in general the way Roths work. Of course, I shouldn't say of course, there's no Maine tax deduction for putting money in a Roth. There's no matching grants. Um, so in terms of paying for college, if you want to tap a Roth IRA for this purpose. So again, I said any age you can withdraw your own contributions. If I'm under 59 and a half and I want to use this money for education, I can. It will become taxable, but there's no early withdrawal penalty um, if I'm using it for qualified education expenses. Um, and then of course, if I'm over 59 and a half, I can take it out at any time for any reason. So it's irrelevant if I'm over 59 and a half. But for folks who are under 59 and a half who want to use it for college, you can for qualified expenses. And then this one, I am going to talk about FAFSA for a minute because it's a retirement account. Retirement accounts are not um, reported on FAFSA. They are reported on the CSS profile, although my impression is they're not often factored into your ability the calculation for your ability to pay. Although I'm not privy to the college's institutional calculations. Um, but distributions from this would count on future FAFSA years. Again, if you're doing this for the first couple of years of your student's education, um, during a year which you will be using that tax year to report for maybe junior or senior year, your distributions would come out and would be, if they're if you're over 59 and a half, it would be untaxed income. If you're under, it would just be reported as income. It will be on your tax return. So it can affect, and income is really a bigger driver on financial aid calculations than assets. Income is more important. So it's important to think about. Okay, I think we're done with that one.
Yeah, Allison, we do have a couple of questions.
Oh, good. Okay.
Yep. This says, if we have a 529 in another state, are we able to open a second one in
Yep.
Maine in order to get the grant? So yes to that. Yep.
Yeah.
And then are we able to roll the funds from the other 529 into the main one?
That's a good question. And I think Mila, might be more well equipped. I had my older kids were too old to get the Alpha money. And at the time, I did research because you could get the Maine tax deduction for contributing in any state, right? Like most states say you get a tax deduction if you put money in our state's 529. Maine's tax deduction is actually broader. And they say, are you contributing to any 529? And so my older kids were in a different state. Then I had two more kids born, got the Alphon grant, and suddenly I noticed other grants appearing in their account that I actually did not know about. So then I said, well, if there's going to be free money, so I opened new 529s for them, left their old ones, and then I just kept two. It just was easier for me. Mila, why don't you speak about, because I think the answer is yes, you can roll another states into Maine, but I think you know more about that than I do.
Yes, you can roll another states into Maine's 529. So what I would say is if someone is interested in that, go to nextgenforme.com and learn more about that. Of course, there's paperwork to be completed in order to make that happen, but it is possible to do that. Yes.
That's why I didn't want to do it. I don't
Yeah.
need more paperwork in my life. And it
Exactly.
was fine. It was fine. And then when my son went to college, took I first took the grants out to pay for college, but then I went to the other 529 in the other state just to close it, like just to get that off my books.
Yeah.
But yes, you can have multiple 529s in different states for the same. You could have two in Maine for the same person. But
Exactly.
you
At one
can't get
point,
the
yeah.
okay.
Um, I didn't mean to interrupt you. I was just going to say at one point,
No.
yes, my mom had one and I had one. So it is possible to have multiple
Yeah. And
next
of
gen
course,
accounts.
divorced parents often
Yeah,
will have, because there can only be one owner on the account. So sometimes people don't want to contribute to an account that they don't have control over. So yeah, it's extremely flexible.
absolutely. So another question for you, Allison. Is
Mhm.
it possible to roll an UTMA or an UGMA into a tax-advantaged account such as a 529? My kids' grandparents started the UTMAs and UGMAs for them, but I'm concerned it will impact financial aid.
Yes. And again, Mila, I think you know more about this than me, but yes, I know for sure you can roll those into a 529. Um, but
Yes.
Mila, do you have anything to add? Any
Um,
helpful information?
No, I don't think I have anything more to add. We actually talked about this the other day, so it absolutely is possible. And the thing I would want to say about that sometimes we get asked is the assets on the FAFSA are as of the day the FAFSA is filed. So there is no look back period. With some other types of programs, you have to have made some changes a certain amount of time in the past in order for them not to count, but that's not the case. Now, that being said, if someone is going to want to make these changes, probably getting them done sooner rather than later is better. But I just wanted to mention
Right.
that particular
Yeah,
piece.
because you benefit from the tax-free growth. So even if you're talking about a 5-year-old and transferring it in from an UTMA into a 529, the growth on the UTMA is taxable, um, and the growth on the 529 is not.
Right, right.
So,
Yeah. Now, one more,
okay.
one more if you don't mind. Is
Oh
there a
yeah.
difference between a Roth IRA and a Roth invested in an employer plan regarding the 5-year withdrawal rate?
Yes, the 5-year rule doesn't apply for a Roth 401k. Um, I think I thought you were going to ask about education, withdrawing money from a Roth 401k for education, and I actually do not know the answer to that. I do not think that you can do it, but I also am happy to find out that answer. Um, I'm going to write that down. I don't think that you can withdraw money from a Roth employer Roth. What you can do is, let's say you no longer work there. If it's an old plan for you, like it's not your current employer, you can roll the old Roth 401k into a Roth IRA, and suddenly you can do this. If it's your current plan, you can't do that. Um,
Well, you're writing that down, Allison. I'm just
yeah,
gonna, there's just one other quick question about the
yes,
FAFSA, and the FAFSA and what year of income that it uses. So the way that the FAFSA works is we call it prior year income. So if we're looking at a FAFSA for the 27-28 academic year, then what we would be using is 2025 income. So when you look at the academic year that the FAFSA is for, 27-28, for example, look at that first year, and it's going to be 2 years prior to that is the year that the tax information is going to come from.
yeah. And to highlight what you said, that's obviously yes for the income, like the tax return, but as you said, your assets that you're reporting are on the day you fill out FAFSA. So it's two different things. It's
Right.
old income information, which makes sense, right? Because if I'm filling it out, if I have a senior this current year, I need to be filling it out, let's say in the fall, if they have early deadlines. And so in the fall of 25, I was filling it out for the 26-27 year, but my 2025 taxes are not done then. So I need to use 2024 because those are done in 25 when I'm filling it out for the 26 year. Yeah, and it is complicated.
It
I
is.
am always trying to think of which year, who's in college, which
Yeah.
year in this year, and it's more complicated because they're calendar. It's academic year and a calendar year, a tax year are almost opposite. So it's
Right.
extremely. You can't say, oh, sophomore year income.
Right.
You have to
Right.
say like the second half of sophomore year, first half of junior year. So,
Exactly. I will put a
all right.
plug in for positive changes to the FAFSA. When people complete a FAFSA now, they have to provide consent for this, but the income information comes over directly from the IRS. So it's important to know what year it's using, but at the same time, that's transferred automatically. So people don't need to worry about inadvertently entering the wrong year. It's going to pull
Okay.
over the correct year from the IRS
Yeah.
directly.
And
So,
you don't have to have it in front of you.
right.
You just you sign it, and then it populates, not even populates, it just pulls it
So,
over.
sure does.
Okay, so I'm not going to talk much about traditional IRAs, but again, there's a provision relating to education. So the way traditional IRAs work, I think probably most people know this. You put money in, you get a tax deduction. So you're putting pre-tax money in. Um, then it grows and grows and grows. You don't pay taxes on it, so it's tax deferred. And then in retirement, once I'm 59 and a half, I can take that money out, but all of the money is taxable at that time. There is an exception. Sometimes sometimes you can put pre-tax money in a traditional IRA. You just have to keep good records, and that money you can pull out without taxes. It's not super common, but it is possible to have after-tax money in an IRA. So the exception for education is this, and this is for yourself, your children, and your grandchildren. Like most other things we've talked about are for anybody. You can withdraw money for education under 59 and a half It is taxable. You don't have the early withdrawal penalty. And again, if you're over 59 and a half, it's going to be taxable either way. It doesn't matter what you use it for. But that's another way that people can pay for college. I think that's it on this one. Okay, I learned all about Trump accounts. So these are new, they're brand new. In fact, they don't exist yet. So we're still waiting instructions, who's going to manage them and like really the details of how they work. Um, what it is a tax deferred account for only for children up to the age of 18. While the child is under 18, it's eligible to contribute up to $5,000 per year. And it can come from parents, grandparents. I think that $5,000 is the max. You can't put in more, you can't have everyone put in $5,000. Once the child turns 18, it converts to a traditional IRA. While the time it's a Trump account, there are no withdrawals at all for any reason. That is my understanding. Once it's converted to an IRA, you can make withdrawals, and it's the same rules as the traditional IRA that I just talked about. So a lot of this in the Trump accounts, a lot of it's going to be after tax money because you're not getting a tax deduction for putting money into the Trump account, and the earnings will be tax deferred. So if I do this and then my student goes to college, well, I was going to say I can, but really they would, it's in their name. They can pull money out to go to college, and any after tax money that went in comes out tax free, penalty free. And it's the same, really, it's the same rule as the last slide because it's a traditional IRA, which is that they can pull money out for education. And then the earnings, because they're not going to be most likely 59 and a half, the earnings on it would be subject to taxes at the student's tax rate because it is the student who owns this account. And there would not be a 10% penalty for that. Let's see. I feel like I have something else to say on this. And then babies born between 2025 and 2028 will receive $1,000 into a Trump account. It's a federal grant. And you can contribute to a Trump account and a 529 in the same year. So I feel like there was a question, Mila.
Yes, there was a question. What happens in the event of a death? So
Oh,
just trying to tie this back to,
yeah.
I don't know if it was specifically related to, which type of account. In the chat, I had mentioned about, we were talking about the Alphon grant at that point in time. So I don't know if that's what it was about, specifically about the Alphon grant. What I would just say in general is that any of the grants, whether it's the Alphon grant or any of Maine's matching grants, if that beneficiary passes away, unfortunately, the grants are gone. They can't be transferred to another individual. But of course, with a 529 account, your contributions, as we talked about, can be rolled over into another account. So I hope that answers the question that was asked. If you want to provide more detail about what specifically, which plans you were talking about, we can address that further.
Yeah, because a lot of account I know for 529, if you you can and should list a successor owner. So if the owner of the account passes away, it doesn't go to the beneficiary. I see that a lot where people think their child is going to inherit it, and that's not what happens. It goes to a successor owner. Um, and then of course retirement accounts have typically beneficiaries, and then it turns into just an inherited IRA. Is
We,
there another question before?
yeah, we did get clarification. So it was
Okay.
specifically about a Trump account. What happens
Oh,
in the
for the
event
Trump
of,
account.
yes.
That's a good question. So, I mean, once it's an IRA, once the child is 18, then I would think it's the same rules, which is you're supposed to list beneficiaries. And then it's outside of probate, right? Like if there's a beneficiary, then the person named inherits it. I don't know the answer for while it is a Trump account. Because I'm assuming we're talking about if the student dies because um, if the adult passes away, then I assume maybe there's a similar to 529, there's just successor owner. I don't know what happens to those funds if the student passes away. But that is actually a really good question. I'll find out. Well, I don't even know if I can find out,
Yeah.
but I can try to.
Yeah. So much is still being worked out
Not
on.
right. There's a lot up in the air.
Yeah.
So I don't know if I can find out the answer to that. Okay. And then I don't know how many people pay for college with savings bonds. I do not find it common. But there's a provision for excluding the interest. So if the bonds were issued after 1989, you can exclude the interest if they are used for education. And with these provisions, so the owner needs to be at least 24 when the bonds were issued, and then the income limits, as it says on here. And then, interestingly, if you file married filing separately, you can't exclude the interest. But that's it. Again, I don't feel like savings bonds are super common anymore.
I know what years ago, Allison, did have some savings bonds and I rolled those into the 529. Um, because you could do that too. I think it depends on the type of savings bonds, but
Yeah, that
uh,
makes sense.
yeah, we did have another question. Are Trump accounts open for all kids under the age of 18 or just those born in 2026?
My understanding is that you could open one for anybody who's under 18. So if you have a 10-year-old, once it opens in July, that you can open a Trump account. That is what I was getting from the article that I was reading. It's just the federal grant that is for babies born between 2025 and 2028.
All right.
Okay, we get to move on. That was a lot about saving for college. There's a lot of options. Okay, so during college, you can go to the next slide because these are the things we're gonna talk about. Income tax credits, this is what I have slides on. The American Opportunity Tax Credit, Lifetime Learning Credit, gifts, and scholarship income. The one thing I'll add, what used to exist is there used to be a tuition and fees deduction that expired in 2021, and so it just doesn't exist anymore. So really, on your current tax return, these two credits are your choices. You can't do both for the same student in the same year. You can't claim both credits for the same student in the same year. And then I'd just say, because I've talked a little bit about tax deductions, and then this is tax credits, and they are different. So a tax deduction is just, let's say I earn $50,000 in a year, and I take a deduction of $5,000. That means I pay taxes on 45, right? Like it's like a subtraction from my income to calculate the tax. A credit is almost always a lot more valuable, and that is a dollar for dollar reduction of your taxes. Um, so, and a deduction is more valuable the higher income you are and the higher tax bracket you're in. A deduction is more valuable for higher tax bracket people in higher tax brackets than lower tax brackets. So for both of these credits, I put the income limits on here, but it's the same for both, which is that this is a phase out. So if you're single, you get the full credit if you make under 80,000 and no credit if you make over 90. And in between, it's just a gradual phase out. And then it's 160 to 180 for joint filers. So what the American Opportunity Tax Credit, I put it first because it's the more valuable credit. You can take it only for the first 4 years of higher education. And the calculation is on here. So it's of the first $2,000 you spend on education, you can take 100% of that as a credit plus 25% of the next $2,000. So the math is up to $2,500 in a year. And of that, $1,000 is refundable. And what a refundable, they're not super common. A refundable credit, like normally a credit would be, I have incurred taxes, right? Because I'm working or I don't know, I have investment income. And so the credit that I get reduces my tax burden. A refundable credit is I don't actually have to have any, I don't have to have any tax burden. I don't have to have incurred any taxes in order to get a credit. A refundable credit, I can actually get money back. I can get money back. I feel like it's gonna get too complicated if I go further than that. And then for this specific credit, qualified expenses include tuition, food, book supplies, and equipment. It does not include housing or food. And then the other thing on this, if you've withdrawn money from a 529 in order to pay these expenses, you can't also take this credit. So for folks who are, let's say, they know they're eligible for the credit based on their income, what they will sometimes do is, if they can afford it, pay the first $4,000 out of pocket to take this credit. And then the rest of it they can take from the 529. You just can't use 529 withdrawals, like the same expenses, the same qualified expenses you can't use for 529 and then also the American Opportunity Tax Credit. So I think that's it on that one. So the lifetime learning credit is much broader in terms of you can take it at any time for any of these kinds of schools. So professional degree, undergraduate, for an unlimited number of years. As long as you have qualified expenses, you are allowed to claim this credit. And then so this one you have to spend, it's 20% of the first $10,000 of expenses. So the credit is worth maximum $2,000 a year, and none of it is refundable. And then this one is different because can be only used for payments made directly to the school. Whereas the American Opportunity Tax Credit was books, things, maybe some supplies that you're not necessarily paying through the college or university. And then, like I said, the same income limits. For both of these credits, you have to file a form called 8863, and you will need a form 1098T, which we actually have what it looks like later. It's just from the college saying, this is the college's name, this is the student's name, here's how much was charged for tuition, here's scholarships, is the student a half-time, is it graduate, are they a half-time student? It has things like that on it. So to prove enrollment, you have to have received that from the college in order to claim these credits. Okay. Okay, so for gifts, I think this is very much not well known, but there is an exclusion. At the beginning, we talked about the $19,000 gift tax exclusion. If you are giving gifts paying directly to the college or university, there's actually no limit on, it's all the gift tax exclusion. You don't have to file a gift tax return is what I'm trying to say. It's only for tuition. So if you were, of course, paying, let's say, room and board through the university, that doesn't count as an exclusion. The other thing is it's not related to education, but medical is the same thing. So you can pay medical bills directly to the provider. And then for this, if you, let's say, I'm going to use the example of a grandparent. The grandparent is just going to pay the parent or the child, like I'll give you money and you pay the school. That's just regular gift tax rules. But again, if you're married, you can give double the amount without having to file a gift tax return. Okay, I think that's it on that. And then scholarships. So they're tax-free if you're in a degree program at an eligible institution, and it's for these qualified expenses. So tuition, fees, books, supplies, amounts for housing, food, travel, or payment for services, like if you're a teaching assistant or a lab assistant, those are taxable income. So most students, their scholarships are tax-free. Because for most people, you're not getting more scholarships than you're paying in tuition. But of course, some people do, right? So you have to be, let's see. So if the scholarship income exceeds the expenses, the tuition fees, books and supplies, the student maybe not has to file a tax return. So really they can have income up to, and this is for 2025, $15,750. So that's a combination, right? It's like if they're employed, they have a summer job or they have, I don't know, a job, and scholarship income above the amount of tuition, that's less than $15,750 for 2025. They don't have to file an income tax return because if they can, but if they file it, the first 15,750 is they just subtract it from their taxable from their income to get taxable income. 2026, that amount is 16,100. But there are still people, right, who are going to have even above $16,000 in excess scholarships. Maybe they got a full ride and to room and board is 20,000. So Mila, can you go to the next slide? Because that's the picture of the 1098T. So as a general rule, so box one is what that is what is tuition? Like what is the college or university charging? And then box five is what kind of scholarships and grants did the student get? So in general, if box one is larger than box five, that student, all the scholarships are tax-free. And then if box five is larger than box one, then you have to think about, does the student have to file a tax return? Even if they don't have to, sometimes they want to, because let's say they work part-time and they got money withheld, but they know they don't owe taxes. You can still file, you will have to report the scholarship as taxable income. But if it's under 15,750 for between the earned income and the scholarship, they will not owe taxes on the scholarship income. If it is larger, then the student will have to file their own tax return. Um, and I would say you might want to get professional tax help because if it's this kind of even goes back to the UTMA and UGMA where I was talking about if they have unearned income of over $2,700, yeah, $2,700, it's subject to kitty tax rules. So it's if a student can be claimed, even if they're not claimed as a dependent on someone else's return, if they're eligible to be claimed, you might want to get professional tax help. Um, okay, so I think that's it. So that's what's available during while a student is in college, and then this is afterwards. Um, so there's one tax credit we're going to talk about, and one tax deduction. So the Maine student loan repayment tax credit is really good, and that's why I put it first. And this has changed over time. It's replaced the educational opportunity tax credit, which was a lot more restrictive. I say this because a lot of people have in their heads, like, I'm not eligible for this because there used to be restrictions on it. It had to be a Maine college or university, and you had to have a STEM degree, and it kind of loosened over time. And now there's just no restrictions. It can be any accredited college or university and any loans taken out after 2007. Um, so what it's worth is up to $2,500 annually. And that's just if I pay whatever I pay to my lender for payments, I can take as a tax credit in Maine up to $2,500. And the lifetime cap on this is 25,000. So I have to get this, I have to live and work in Maine. And this one is opposite from a lot of the other ones because the other ones, a lot had maximum income limits. Like you can't do this if you make too much money. This has a minimum earned income limit in order to get this credit. So the calculation is whatever the state's minimum wage is for that year times 936 hours, which is $13,712 for 2025. So this is a dollar for dollar credit. I know of people who could pay off their student loans more quickly and actually are not they're paying $200 a month to maximize, well, $208 a month to get this $2,500 paid credit because they look at it and say, the state of Maine is going to pay this for me. So why would I pay this off earlier? Because I can essentially get it for free. And of course, this was designed to, bring young people into Maine, right? So for the first year, you have to provide some documentation, and you have to provide a copy of your college transcript and documentation that show that loans qualify. I think what that means is that they were issued after 2007, and that for that first year, documentation showing your actual payments made during that tax year. You could probably use like a screenshot if you're logged in, or maybe your lender sends you a statement. In subsequent years, you're not automatically like that stuff you have to send in with your tax return that first year. Later years, you don't automatically have to send anything, but of course they can always come back, right, and ask you to prove that you made these payments. If married taxpayers both separately qualify, they can each get up to $2,500. And then if you missed qualifying, because I come across a lot of people that have never heard of this or think they're not eligible, you can amend your Maine return for up to 3, and this is for any purpose, this is not specific to this tax credit, but you can amend your Maine return for up to 3 years after the original due date and capture that credit for those prior years. I think that's it on that. Oh yeah, the FAQs on that. Like if you go look up that student loan repayment tax credit, it's like 2 sentences long. It basically says if you have loans after 2007, you can get this credit. If you go into the FAQs, there's a lot more information about that. Okay, and then this federal student loan interest deduction. This is not new. This is a deduction. It's not a tax credit. And then it only is for interest. So it's not the other tax credit was for the full payment. This is only the interest portion, up to $2,500 a year. You can take the standard deduction and still take this. You don't have to itemize in order to claim this credit. You need Form 1098-E from the student loan servicer because that tells you, like, let's say you paid $2,000 last year. It's going to tell you of the $2,000 what was interest, because most people are not tracking how much of their payment is interest and how much is the principal repayment. And then the income limits to claim this are, it phases out again. So up for single filers, if you make below 85,000, you get the whole, you can take the whole deduction and it phases out till you get to 100. And then it's 170 to 200 for married filing jointly. So that's all I got.
That was a lot, Allison.
A lot.
I did also put in the chat publication 970
Yeah.
because that's, I think, a really great resource of how not only a lot of these programs work, but how they interact with each other too, right?
Yeah, exactly. I think
Let's see.
I mean, we hit a lot of questions along the way. So I
Yeah,
don't know if
got a
there's,
couple. Yeah, a couple just came in. Would the Maine State, excuse me, the Maine Student Loan Repayment Tax Credit apply to loans taken out for graduate degrees?
yes, it's any associate's, bachelor's, or graduate degree after 2007.
Exactly. That was one of the nice expansions that they did.
Yes.
Yeah.
Yeah.
Can you claim for both of
Oh,
those for the same repayments for the same year?
yes, because one is federal, so you can do the student loan deduction, interest deduction on your federal taxes, and then you can take the Maine student loan tax repayment credit on your Maine taxes.
Any other questions from people? Go ahead and put them in either the chat or the Q&A, whichever you prefer. And just a reminder that we have been recording this presentation, and I will send out an email with a link to this presentation early next week so that you can re-listen to any parts that you would like. But yeah, all right. Well, I'm not seeing any additional questions, Allison, so I think we're good.
Yeah, we give them back their 4 minutes.
Yeah, everyone would like probably a few minutes back in their day. You are very welcome. So, well, wonderful. So I'm going to stop recording. I hope you all have a wonderful day. Stay warm, and we will be here if you need us for anything. So take good care. Try and stop recording. Sorry. I had, it keeps disappearing on me. Sorry. Jeez, I'm a crow. There we go.